Good morning, everyone. This is Amit Pabari, founder and managing director of CR Forex. One of the most important events which the entire world is going to watch is US election, which is due on 5th November. In today's presentation, we are going to discuss how it is going to impact global currencies. Let me share an interesting data point with you. If you see the table, you will observe that when we were preparing for our masters or when we started our career, at that point of time we used to say that any president in US who becomes a president will at least stay there for 2 or 3 terms, but the trend got broken with Donald Trump, and Joe Biden is not going to contest election this time, so the trend will continue. In order to predict the future of dollar index and global currencies, let us see what has happened in the history. If you see the table from 2000 till 2020, every time after election, generally dollar index had gone weaker. Exception year were two. One was in 2008 and one was in 2016. 2008 dollar became stronger because that year was a year of global financial crisis. 2016 Brexit happened, because of which pound had fallen drastically. So history suggests us clearly that post US election dollar generally gets weaker. Now the big question is what is going to happen this time. In order to understand that, let us see and understand what the current candidates like Kamala Harris or Donald Trump is promising in their election campaign. From that, we'll be able to understand what policies they are going to come up and what impact it is going to have in US economy and dollar. If we listen to Kamala Harris policies, what she has been proposing in last 15-20 days, she is saying that she is going to increase capital gain tax, she is going to charge wealthy people wealth tax, and probably she is going to regulate energy to the great extent. Because of all of this reason, we expect that fiscal deficit in US is going to increase, or investment in US is going to come lower. This will have a negative impact on dollar. Now let us move ahead with Donald Trump policies. If we remember his last tenure, where he categorically said that he did not like stronger dollar, he liked weaker dollar, and he wanted exports to get promoted from US instead of import. So probably he is going to put more tariff on imports. He is going to do tax cut without spending cut, and global trade will be volatile. Because of all of this reason, we expect dollar is going to get weaker if Trump also gets elected. So now let us conclude. Both Harris and Trump policy indicates that their fiscal borrowing is going to increase, which is going to be a negative for dollar index. Dollar index is going to face a strong resistance between 103.50 to 105 kind of level. In coming days, we are expecting dollar index to move towards 100 kind of a level, that is the first target, and 98 after that. If that happens, then euro USD, which is currently trading near 1.0866, can move towards 1.10 kind of a level, and then 1.12 kind of a level. Similarly, GBP USD, which is currently trading near 1.3050 kind of a level, can move towards 1.32 and 1.34 kind of a levels. Now let us discuss outlook on rupee. The rupee is expected to face a stiff resistance near 84.10 to 84.15 kind of a level, and there are 80 to 90% probability that rupee might move back towards 83.80 kind of level. There are few reasons for the same. Let us discuss that. The first reason why we expect rupee to get stronger is we are expecting dollar index to again move back towards 102 kind of a level from current level of 103.50. We are expecting dollar index to get weaker. Why? because we are expecting market will start focusing again on US election outcome and Fed cutting the rate. If that happens, dollar likely to get weaker. The second reason, we have seen a reversal in crude oil prices. In last 8 to 10 trading session, crude oil price have fallen more than 10%. It is a positive for a country like us who is dependent mainly on imports of crude. And if we see the data for the month of September, our trade deficit came at 5-month lower. That is also a positive for rupee. And the final reason is RBI determination. In the month of October, FII have sold close to 10 to 11 billion from Indian equity and debt market. RBI kept on supplying dollars in the market. In the beginning of October, our reserves were standing close to $704 billion. On Friday, the data showed that it has dropped from 704 billion to 690 billion, which shows RBI determination to avoid volatility and to avoid sharp depreciation in rupee. Now let us discuss strategy for thin margin exporters. Thin margin exporters like agri exporter or chemical exporter, for them what we are suggesting is the traditional wisdom suggests that whenever the market is trading near top, you should sell an asset, and whenever market is trading at a lower end, you should buy that asset. Currently, rupee is trading near 84.05 kind of a level. We will suggest all thin margin exporters that they should go and cover 100% on a back-to-back basis. If someone wants to wait, they should keep a strict stop loss of 83.95 or costing, whichever is higher. For thick margin exporters like textile exporter or chemical exporters, we will suggest that they should maintain a hedge ratio of 75 to 80% if they are hedging on a confirm order basis, and if they are hedging on an anticipation basis, they can maintain a hedge ratio of 60 to 65%. Between 84.05 to 84.10 kind of a level, they should ensure that they are participating and maintaining the above mentioned hedge ratio. Now let us discuss strategy for importers. For importers, there are two steps. First step is that they should keep a strict stop loss of 84.10 and wait for a lower level of 83.85 to 83.90 to cover their near-term imports of 10 to 15 days. If 84.10 ka stop loss is getting hit, then they should ideally go and buy 30% of their imports which are due for next 10 to 15 days. With this, I will end my today's presentation. Jai Hind, Namaskar, फिर मिलेंगे next week. Thank you.